Well, one of the things that when we were chatting initially, I really love your phrasing. That all you have to do really at the end of the day is be mostly right, and I want you to kind of go into that a little bit more because a lot of folks, when they're either sharing their knowledge at cocktail parties, they always want to talk about their big winners. They never want to talk about the things that they were wrong on.
Right.
Yet, sometimes there is something about how you handle the ones that you're wrong on, and how you handle the ones that you're right on, how you get more money into those. What's kind of your philosophy, and how does mostly right save the day for you?
That's the right question again. So, uh, some of the best work we do for our clients are the names that we got out of or the ones we never got into in the first
Yeah.
place.
Hmm.
And that's hard to quantify. So but it shows up in total return. So I'll give you an example. I can give you two examples. I wrote a book on investing for women. And when I was working on it in the first edition in 2014, I was trying to find a way to explain how you put a portfolio together. So I'm Googling late at night and I came across an interview I'd given 10 years before, didn't remember it. And so I said, well, this is perfect. I'll just look at the performance of the five stocks. Two out dramatically outperformed the market, two kind of in line
Hmm.
to underperforming, and one dramatically underperformed. Yet that portfolio was up 100 full percentage points cumulatively from 2004, April 2004 to 2014. Fast forward, last year I had a 5 for 25 portfolio. One of the names was ServiceNow. That was down 27% last year. Spotify was in there. Goldman carried the day. I can't remember right now what the other ones were, but that portfolio was up 28% last year, even with ServiceNow down 27%. So
Hmm.
that's what I mean when I say mostly right. Now, in real life, as soon as a stock gets clobbered, we go back in and do the fundamental research. We have a proprietary model, the 12 fundamental factors, three qualitative, nine quantitative. We go back in and say, would we buy this stock again today? If the
Hmm.
answer is yes, then we add to it. And if the answer is no, we exit. That's what we did with Adobe, Salesforce, Zillow many years ago, CVS. Those are names that Intel, poster
Hmm.
child of underperformance. So those are names that we got out of because we didn't think the management was on top of it. We didn't think there was a catalyst for outperformance. And so in every case, we got out at much higher levels than the stock is trading at today.
Yeah. And I would refer to your last appearance on Investing with IBD because you did go through that 12 metric framework. You shared your nine quantitative and three qualitative metrics, and talked a lot about the the strategy of buy and hold but verify or something like that, if I remember correctly. To make sure that it's worth holding. And to your point, it's one of those things. Would you buy it today?
Yeah.
So also want to kind of share some of the things. You brought some slides to share with the class, so I want to make sure we get to some of those because I thought that there were some really interesting points that you were making here. So I'm going to go ahead and switch over to some of those slides. And one of the first ones that I found really fascinating, again, because a lot of people are so focused on the the macro, the geopolitical, the noise, all of this, this wall of worry that we've been climbing, it seems like, for so long, with headlines tossing us to and fro. And you have this, pretty neat chart about how the geopolitical crises will sometimes create opportunities. So maybe explain what your thesis is here.
Yep. So this is from Ed Yardeni, the master chart maker. And
Mhm.
I can actually just share a real life example. So I was managing money beginning in the 1980s. And 1990, Iraq invaded Kuwait. We had just taken on a $100 million client. I was investing from the labor and delivery room, which don't do the visual, and the doctor pulled the phone away. But the point was, I was frantic because the market was melting down, and we were trying to get the money invested, but not too quick. You can imagine.
Yeah.
And so, at the end of the first 2 months, the 100 million was now worth 80. And then we went on to be their top performing manager because what happened? Well, we went into Kuwait, the US that is, and the day we entered, the market went up straight up. It really bothered
Yeah.
people. They were like, "It should go down. What's this is war."
Hmm.
But it went up because the uncertainty was gone, and it kept going up thereafter. And so we've seen that. We saw it with Russia-Ukraine war, most recently with the Hamas-Israeli attacks. You can see we've just continued to climb that. And then if you go back, and I'm looking at the chart, so I'm not losing my mind, but that's what happened in every single situation. North Korea, the market went up. Cuban Missile Crisis, the market went up. It naturally climbs a wall of worry. But what the reason people don't think that is because the bears always sound smarter than the bulls. The bulls are like the eternal optimists, which I'm
Right.
I'm not necessarily, but I'm more optimistic than I am pessimistic because I believe in our country's ability to adapt and innovate. And that's how you generate earnings growth, and that's what drives stock prices.
Hmm. I'm just gonna. I know this isn't your chart, but maybe next time I run into Ed Yardini, I'm gonna say, hey, maybe add 2003 because I thought that was an interesting one too.
Yeah.
March, I want to say March 12th or March 17th, we had what we call a follow through day, and that was right around the time of shock and awe
Yep.
that was happening, and it
That's a great
finally kind of pulled us out of that ugly.com bubble bursting and the bear market that ensued where the Nasdaq was down 79%.
and the
Um,
3 years of moribund returns. Yeah.
yes, absolutely.
That's a great
So
point.
yeah, no, it's a great chart. And to that point, one of the things that does happen, and you and I are going to spar a little bit on this one because you make a good point that uh, a lot of times you espouse the belief that your time in the market is a lot more important than timing the market. And I think this is the poster child for that point. So maybe describe what this is showing our listeners here.
Yep. So it's a 30-year period, and it was developed by our friends at anyone can do it, but our friends at Strategas published this particular chart. And what it shows is if you were invested in the S&P 500, you would have returned 9.1% annualized over that 30-year period. If you miss the 5 best days, your return declined to 7.4% annualized. If you put that in dollars, 9.1% over that 30-year comes in above 13 million. I think it's 13 and a half. And then if you missed those 5 best days, you were able to still generate 8 million, but the difference was over $5 million.
Hmm.
And I think if people think about it in dollar terms, because if you look at it, you go, well, 9.1, 7.4, it's not that big of a difference. But the compounding of that over time becomes compelling if you're interested in generating wealth for your future. And that difference is big.
Yeah.
13.5 million versus 8. That's a lot of dough.
And you know what? I'm gonna skip ahead because this
Yeah.
really kind of illustrates that point. And for people that haven't like done these numbers themselves, it's again, there's so many things about the eighth wonder of the world being compounding,
Oh, yeah.
the magic really, and it does feel like magic sometimes because the early years are such a grind, you just don't see that much of a difference, but then later on, if you are able to pull that lever a little bit of raising your performance just slightly, the difference it makes, after 10 years, 15 years, it becomes really astounding. So, to your point, if you can do anything that just increases that average a little bit, that average compounding annual growth rate, the results are astounding.